Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide with guidance. There's the disclaimer.
Excellent.
With that, let me share my screen. While I'm doing that, if anyone's joined us for the first time, as a quick note, Will and I, we do these shows in the morning to try to help answer questions you may have about any of the Market Chameleon tools, data, analytics. If you have a question, you could type it into the live chat on YouTube. While Will's watching it, he'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. If you click on that link, it takes you over to Zoom. Once you're logged into Zoom, click on raise your hand. Once we let you in, you could ask your question live and direct. While we're waiting for more people to join us and give you guys a chance to put in your questions, we're going to take a couple minutes, take a look at the pre-market report, see if we could get some insights, what's going on today in the pre-market hours, and then we'll go to the questions. All right, so let's start out with the pre-market report. These are stocks that are trading in pre-market hours. Let's scroll down here. And we have three lists here: our most active stocks, biggest percentage gainers, biggest percentage decliners. If we look at the bottom of the list, we see 33 stocks made our percentage gainers list, 38 stocks made our percentage decliners list. So from this perspective, it looks like the trading in the pre-market hours is a mixed bag, maybe slightly more bearish sentiment, when we use this analysis. Let's scroll up and look at it from another perspective. If we come up here, we have a calendar view that you could click on, which brings down these reports. Today, we're September 18th. Right here, we see from the top level, high level, we have 304 stocks that are trading higher than Friday's close. We got 348 stocks that are trading in the pre-market hours lower than the previous close. If we took the volume, the number of shares trading, 135.7 million shares traded on up volume versus 92.2 million shares traded on down volume. And if we converted those shares to dollar value, we have $609 million worth of stock trading higher versus $2.2 billion trading lower. The reason for that is that not every share of stock is at the same price. We've got dollar stocks, we got $100 stocks. So if we convert it to notional value, you could see that $2.2 billion worth of stock trading lower versus $609 million trading higher. So this also is indicating there's more bearish sentiment in the pre-market so far in the trading, before we open. So let's come down here, take a look at it from one more perspective, then we'll go to the questions. When we started on this list, you'll notice that there's stocks in there that are small cap stocks. We have ETFs in there, leverage products. It could be a closed-end fund, preferred stock. So pretty much any security listed on a major U.S. exchange, if it's trading in pre-market hours and it meets our thresholds, it could make this list. And to narrow it down to a smaller group of stocks, we can use the filters here above. You can filter by your watch list if you saved a watch list. Let's use this filter here in ETF. And when you click on it, you get a drop-down menu to select from. The top one, SPY, that's the S&P 500 ETF. So when we click on that, the the list below will get filtered by stocks that are holdings in the SPY ETF. Right. So here we see two stocks made our percentage gainers list, 7 on the decliners. Again, this list, the gainers list and the decliners list, we do set certain thresholds to make this list based on price movement, volume, liquidity. It's a big thing, the liquidity in the pre-market. So here it's shown slightly bearish bias at the open. So far today, that's what the indication is, that the trading in pre-market slightly more bearish sentiment. I guess we gave it a couple minutes. If you have questions, we could go to the questions.
Yeah, we did have a couple questions pop up from Jackie about leaps. He's like, question, why long-term call expiration date Jan 25? Is there nowhere to find edge and win rate data? I don't know if there is, or if this is what Jackie's asking. How do I find long-term call leaps using MarketChameleon? I guess, how does he screen for him? Is that a possibility?
Okay.
He then goes on the ask. I don't know. He's never seen a trading card. I guess he uses the trading cards that had long-term leaps showing up. So that's the questions are all around long-term.
Okay. All right, let me take let's come down to the trade cards here. And thank you for a question. It's a good question. Under options, we have trade ideas. In order to evaluate an option in a trade, one of the most critical things as a trader, right? You'll find out, if not from the beginning, but over time, is that when we look at a market price of the security, right, we're gonna know, what do we think in theory this price should be, what's the value of it, right? So when we look at prices, we run models to see where do we think it should be, how far away did it diverge, right? Is this a good price? Is it a bad price? Did it diverge too far to the to one end or the other? And to price options, you could use different models, right? So there's no one right model. The models themselves are just giving you output based on the input that you're using. So if you're using based on these assumptions, based on this data set, what is the value of this option? And usually that's your base model starting point, and you start to tweak it. Okay. So the idea is, okay, we have this market price, but how do we price this option, right? Well, the option pricing model will tell you, if you trade an option, if you trade the option and stock volatility, if you trade the volatility, this is a model that you could try to price the volatility, right? But other people just either will buy the option, sell the option, and hold on to it, not hedge it, and not trade it. So then we could come up with a different model to say, okay, well, it's a statistical model, right? So what is the price of this option? Well, what do we know is that it has X amount of days to go, and the stock has to move by a certain percentage, right? For if you're long a call, it has to move by a certain percentage to the upside for you to make it for that option to be profitable at expiration, for put to the downside. So to price it, we need to know, well, what's the probability of that happening and what is the payoff? So let's just set this up for a second. And your question, it has to do with, I'll explain to you with the leaps. But if we had a simple outcome, a coin flip, heads and tails, right? Heads, and tails. Well, if that's all we knew, right? If there's a heads and tails, those are the only two outcomes, then we know it's 50-50, right? The probability of it is 50-50. And if the payoff in each one is $1, like for every dollar you bet $1, you either win $1 or you lose $1, then there's no edge. It's a break even. It's not a positive edge, not a negative edge. But if all of a sudden, the markets start betting heavily on one, and the payoff, so the odds don't change. Let's say the odds are still heads or tails. You flip a coin, heads or tails. But if the markets heavily bet on one, then the payoff could change, right? All of a sudden, well, if heads comes out, let's say you have a $2 payoff, right? And if tails comes out, you lose $1, right? Well, so the odds are still the same, 50-50. But if you bet on heads, well, you stand to make $2. And if tails comes out, you lose $1. Well, then based on that, you have a positive expected value, right? You have edge, right? 50% times 2 is $1, plus 50% minus $1 is 50 cents. So you got 50 cents expected value, right? Over time. So those are the things you start to look for. Does it have a positive expected edge? Do I know? Now, keep in mind, I'm not trying to predict that heads is going to land, right? Because I don't know. Like, that is still random. You flip a coin, heads or tails are I have no idea. And the odds of each one of them is still 50-50. So I'm not trying to predict the outcome of the coin flip. I'm just looking at, does one have a positive expected value? Does the over the other, or is it a break even here by my estimate? But so that's one scenario. But what if we had another game? Let's say, and I'm going to make this easy. Let's say it was heads or tails, right? Let's say it's heads and tails, and it's $1, right? But let's say that for some reason, right, we find out that tails ends up coming out more because of the way the coin is flipped, whatever it is, of the ridges or something in there, that tails, we figured out that, hey, there's a slight edge in tails. So it's not 50-50 anymore. Maybe it's something like, 48%, 52%. Okay. So here, the payoff is the same. If it lands on heads, still getting $1. I mean, I still lose $1. If it lands on tails, I make $1. But my odds are a little bit better on the tails. So now I have a positive expected value on the tails, because now 52% of the time I make $1, 52% times +1, and then I got plus 48% of the time I do lose $1. So now you have a negative $1 times 0.48. You lose it, so you got a positive expected value, right? And keep in mind, on both these scenarios, right, it's what's important, because I think when people look at the trade cards, we're not trying to predict what the actual outcome is, because we don't know, right? These are things that are going to happen later in the future, after the game is played, like a football game, or coin flip, or stock market. We don't know for certainty what will happen in the future, but we're trying to predict the odds and the payoffs, and if there's a positive expected value. So with these scenarios, the benefit, if we laid it out like this, right, it would be easy to calculate, because all the parameters then are given to us. They're all fixed. The payoffs, the odds, everything is handed to us. So that would make this game super easy the way I just showed it to you, right? Because we could just run it really quickly through a formula and find the expected value. Just like if you went to, casino, it's super easy to figure out, on the roulette, the payoffs, the odds, it's all fixed. It's objective. There's nothing subjective. There's no opinion in there. These would be like hard facts if these existed. But what happens is in the stock market, we don't have such a thing, right? Because a stock could be anywhere in a week. It could go, if it starts at 100, it could be in a week 100. It could be 101 penny. It could be 102 pennies. It could be 100. So there are many different, outcomes for a stock from now to 2 weeks from now. Let's say you're looking at a 2-week option, right? So all of a sudden, we're faced with that. Well, what are the outcomes? The outcomes are not fixed. So there could be a lot of different outcomes. Well, okay, so we have to deal with that. And then we have to figure out what the payoff is at each outcome. So with an option, it's not as hard to figure out the payoff if you know what the outcome is, right? Because if the option is in the money, you can take the difference between where the stock is, what the option will be worth, and then you could figure out the payoff. But to figure out where the stock is very challenging. And so we could narrow down, right? We could narrow down the possibilities. Think of it as, in a way, when an insurance company tries to sell somebody life insurance, they don't know exactly when the person comes to the end of his term. There's no way of knowing. But they know you're not going to live to 1,000,000 years, right? With certainty, because that's never happened. It would be a big miracle, right? They're not going to be 300 years old or 200 years old. So, you could start narrowing things down, right? And then trying to assign probabilities based on your historical data, right? You could start using historical, just like a football game, right? I don't know what the outcome, the score of the football game will be, but, I know it's not going to be 1,000,000 points, right? I know it's not going to be 500,000. It's not going to be, so I could start narrowing it down and trying to use historical mathematical models to get closer and closer to where I think it should be, right? So we need to figure out the distribution of returns. You need a probability distribution of returns to estimate what is the probability. What do you think the probabilities are of the stock landing here, here, or here? All right. So that's what we need. We need a probability distribution, right? So to figure out our edge, we need the probabilities of the outcomes. How else are we going to do it? We could, there's when you're looking at the options chain, right? When we're looking at the options chain, we're really looking at a, probability distribution, right? The probabilities of the stock ending here, going here. So we need to figure that part out. But here's the problem. This probability distribution, right? This probability distribution is subjective, meaning that when people create these models, right? When you're starting to create these models, you're now putting in assumptions and opinions and inferences, okay? Because we don't have the actual probability, right? It's not handed to us. It's not as easy as what I just showed you with the coin flips, right? Or even if you play a game with 10 numbers, you spin it and there's 10 numbers that comes out and they're all equal chance, then you know the probability of the number 6 coming out, or number 2, or a dice, right? You know the probability because there's 6, 6 numbers in the dice or whatever, and you know the probability of each one coming out. But here it's not like that. So now we have to start trying to estimate the probability of these outcomes. And how do we do that? Right? Well, we could start out doing a base model, right? What a base model would say, okay, if I'm trying to figure out what is the probability, in 20 days, so we have 20 days for the stock to move, right? So obviously in 20 days, the stock could move much more because it has much more time than it can in 1 second, right? So there's a difference between in time, right? So in 1 second, in 1 minute, in 10 minutes, as you increase the time, right, the stock has a lot more a probability of moving a lot more, right? We know that because in 1 second, maybe it'll move like a couple pennies, or maybe even a little bit more, but over time it could really move a lot more. So we have the time, and then we could start looking within 20 days, start with history and show me over 20-day periods, right? What were the returns? So that would be our starting point, right? Over 20 days, what did, how often did the stock move 2%? How often did it move down 5%? How often did it move, right? So now we could start creating a return distribution to help our model, because we need to create these odds, right? So this is a base model, right? We're creating a base model to get ourselves started, right? Before we start tweaking it. So let's say if I had to create a distribution of somebody, lifespan, right? You start taking the data, you get the mean, you got the average, you got your standard deviation. So you create this distribution to try to figure out, how likely is somebody to live till 80? How likely is somebody to live till 90? How likely is somebody to live till 60? And then based on those probabilities, you take the payoff, and then you could get your expected value for that security. All right. So this is the base model. Okay. Now, there are techniques with these distributions, right, that when you handle data, all of a sudden you're going to have to start cleaning it and preparing it to give you a more correct answer. Okay. So what do I mean by more correct answer? If I throw in all the data, right? Let's say I throw in all the data in there. Well, not all that data is going to be relevant to this current situation. So let's say in the next 20 days, I'm trying to price out an Apple option, but in the next 20 days, I know that, Apple's not expected to report earnings. Well, if I take all the data in the last 4 years, right? Well, there are going to be instances in there where there were earnings dates, and on earnings, right? The probability on earnings, right? Probably on earnings for the stock to move up more increases, right? So let's say, for a plus 5% move on earnings, there's, let's say, a 30% chance, right? A plus 5% move on 9 earnings, right? There could be a 10% chance, right? So if that's the case, and I'm trying not to price, to price it more correctly, I'd have to remove that data. Got to take that out because I'm not expecting this event, right? I'm not expecting this event to occur. I could already anticipate the event, right? I could anticipate the event because they schedule earnings once a quarter and stuff. So now I have to take that out, right? And I got to rerun my probability because I don't want to skew my results and get the wrong distribution. What about the data that I use? Should I be using 1 year, 2 year, 3 year, 4 year? Well, that's subjective too, right? You might want to look at it. You might want to look at the 1 year data. You might want to look at the 2 year data. You might want to look at 3 year, 4 year, and you might want to split them up and compare them because how consistent is this distribution? How consistent are these probabilities? These are the answers you have to start looking at because you have to handicap and compensate for those because you want to try. And remember, this is subjective. Your models are competing. Everybody's not coming to the same conclusion. But you're trying to come up with a practical model that you feel comfortable and that you think that the price at this current stage offers a good opportunity, right? That it's either gotten away far enough that it has a theoretical edge. Okay, so those are the questions that we're trying to map out using our models. So let's say we do all this. We have to keep in mind that the outcome's still subjective. Did we not count something in there? Is something different in the next 20 days, that my model is not even considering? How do I compensate for it? So if the next 20 days, something's going on in the market, that is not in your data, then your data is not pricing that event in, right? So whatever it is, maybe a government shutdown or there might be some new law that's about to get passed that's going to impact your stock or whatever it is. You have to take that into consideration. All right. This is your job as a trader. A trader has a lot of human touch. So the question really quickly, because I'm getting to the end. Well, why aren't we generating this for the leaps? So if we're looking at the probability distribution, not the option pricing model, which puts in volatility, if we're putting in a probability distribution and we need to figure out, well, over 3 years, what's the probability of this happening? There becomes much more unreliable because how much data do you have over a 3-year period, right? Like, how do you use that? Because now you need data over a 3-year period, from here or whatever it was, 2-year period. You have to have enough data in there. And, how far back do you go? Because the further you go back in time, the less relevant it becomes, right? So think of it this way. If I'm trying to create the probability of these two teams, right? These two football teams, right? And I'm trying to calculate the probability or handicap, which one is more likely to win. Well, I could start using data and analytics to create my base model. But if I go back 5 years, I might be using data that's completely irrelevant because the makeup of those teams were different, right? Like if I look at the Jets or whatever, like 5 years ago, well, they had a completely different players, different maybe coaching. Some of the players that are the same might have gotten better, some got worse. So as you go further and further back in time, then you got to deal with that. Well, which of that data that I'm using from 5 years ago is still relevant? Is it relevant enough that I could use it in my model, right? And that becomes also important because what am I trying to model? And am I using the data that's even useful anymore? Because if it's not relevant, right, then your model doesn't know that. It just gives you an output. So these are things that we have to always consider in our models, in our evaluation models. So from the point of view of create a probability distribution over a 2-3 year period. The problem is there's not enough reliable data to run, I think, in my opinion, to really create a good probability distribution around that. Shorter periods, 5 days, 10 days, we have recent data till we could start modeling out, saying that, the distribution of returns may look similar. They're going to shift, right? They're not stationary, but we could kind of model them out that, how much are they shifting by? We could give them some degree of freedom there. But over 2-3 year data, you might have to use the option pricing model and just try to estimate the volatility, and even that alone, how do you estimate the volatility going out that far out is very hard. It's I don't know how reliable, you could run a model doing that. Most of the time, I think you start with those pricing in, something that far out, you start having to do what we call a relative value model, where you start to look at similar assets going out that far, trying to use where they're at to price, which is a completely different model. But we went over 9:30, Will, so I'm going to stop there.
We're right up. We're on 2 minutes into the opening. Hopefully that helps, Jackie. Obviously, it's based on the model and the inputs, and you go further out, it's hard to actually don't do it. So there's no availability of that. He did ask, is there a way to search for leaps where the IV is less than historical IV? I'm assuming based on time, that becomes maybe less relevant as well. But that was a question he had. We could attack that tomorrow if you want.
Let's take that tomorrow.
And we had another question from a new MarketChameleon who was asking, is there an option chart that shows the expected move week to week? Specifically, the chart shows one standard deviation share move based on option information. So I'll copy those 2 questions down, and we'll try to hit them tomorrow. How about that?
Yep, sounds good.
Awesome job, D. Thanks so much.
Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trading Peace, have a great day. Thanks, D.
Bye.